All right, for this video, we want to have a look at the various ways an LLC can be taxed for U.S. federal tax purposes. And specifically, we're going to be looking at single member LLCs. So a single member LLC is an LLC that is created and it has only one owner, so one equity member. And we're not looking at multi-member LLCs. A lot of the tax rules are kind of the same, but the focus of this is just going to be on single member LLC taxation. And one of the reasons for that is the single member LLC is probably the most common structure that you're going to see. Most new business owners, entrepreneurs are setting up companies and they're just the only owner. So we've got a couple of slides here. So we'll talk about the default tax rules for single member LLCs. What is kind of the baseline if you decide to do nothing with it. And then we'll talk about the various elections that are available. So LLCs can make C corporation elections or an S corporation election depending on the ownership structure. And then we'll talk about some of the various rules for foreign-owned single-member LLCs. So these are LLCs that are owned by non-U.S. persons. And then lastly, we'll cover the difference in domestic versus foreign single-member LLCs. So there's some different rules there. Okay, so if we start with the default rules. So when you have a single-member LLC, so that's an LLC with one owner, it is referred to as a disregarded entity for federal tax purposes. So a disregarded entity effectively means that the entity itself isn't really regarded or treated as a separate entity for tax purposes. All the activity flows through to the owner's income tax return. So we have domestic eligible entities here. So this would be a U.S. LLC. Domestic meaning that it's an LLC formed within a U.S. state. So Delaware, Florida, New York, whatever you might have. Now, a domestic eligible entity formed with two or more members is going to be, by default, a partnership for federal tax purposes. So, again, we're not focusing on the tax rules for multi-member LLCs. We're just looking at single-member LLCs for this purpose. So if we look at a simple example here, so let's say we have John Doe. He opens a Florida LLC, and he's going to use it to buy a rental property. Now, because it's a single-member LLC, with John being the only owner, the LLC is a disregarded entity, so all of that rental income and expense is going to be reported on John's personal return, and so that's going to be in Schedule E, Part 1 of his Form 1040. A second example here, let's say we have Jane Smith opens a Delaware LLC, and she wants to trade stocks and bonds through that LLC. So she opens a brokerage account for that LLC. The LLC is a disregarded entity. Now, the brokerage account, when the Form 1099 is prepared and sent to Jane, because this LLC is disregarded, all of the activities from that 1099 are just reported on her personal return as if she held the brokerage account individually in her name. So if we have interest income, dividends, capital gains on the sale of stocks, Jane's going to report all of that directly on her 1040 as if the LLC wasn't even there, if you think about it that way. So interest and dividends are just reported on Schedule B of her return, and then those capital gains and losses are going on the 8949 and then the Schedule D. If we look at a corporate owner example, so let's say we have a Delaware corporation, XYZ, and the entity, because it's a corporation, it's taxable as a C Corp for federal tax purposes. Same kind of scenario here. The corporation establishes a separate Delaware LLC, so it opens a subsidiary entity. A Delaware LLC is its subsidiary, and the LLC is disregarded, right? They haven't filed any elections for it. So all that income and expense that's attributed to that Delaware LLC just gets reported directly on the corporation's Form 1120. So again, you're looking at it almost as if the LLC isn't even there. Now, what if we have a partnership type scenario? So let's say we have ABC Partnership LLC. It's a Wyoming multi-member LLC. And this entity decides to open another subsidiary. So it opens another Wyoming LLC that's owned 100% by ABC Partnership. The LLC is a disregarded entity. So again, all the activities of that subsidiary LLC, the DRE, disregarded LLC, are just going directly on the 1065 for ABC Partnership LLC. So that's high level, kind of some examples as to what happens when you have a single member LLC that's disregarded, and then it has those varying types of ownership. Okay, so now on to the C Corp election. So if you have an LLC with only one member, so again, a single member LLC, this entity can file an election to be taxed as a C Corp. Right, so the C Corp election now changes it from a disregarded LLC to a regarded LLC. It's now a C Corp for federal tax purposes. So now, even though you might have a single member LLC with only one owner, the owner is no longer reporting the activity directly on their return. The entity itself, the LLC, is now required to file a Form 1120, and it reports its income and expense, balance sheet, and all the activities that are happening within that company. So who can make an election? Well, there's generally no restrictions on who can make this C Corp election for a new entity. It doesn't matter whether there's one owner and it's a U.S. person or a non-U.S. person. It doesn't matter whether the LLC is owned by a partnership or another corp or even an S Corp. It can always make this C Corp election. Now, the election is made by filing an 8832, and that generally has to be made within 75 days of whenever you want it to be effective. So if we look at an example here, let's say we have Bob Jones. He's an individual, opens a Delaware LLC in May, and he's going to be the sole member. So this is a single member LLC. And he wants to file an election to make this entity taxable as a C Corp. So Bob has to complete the 8832, files it within 75 days of May 1st, 2025, if he wants it to be if he wants the election to be in effect on the same day the entity was formed. So he's going to have to file this on or before July 15th, right? So it's pretty straightforward. Now, why would you make this election? Well, maybe the election is simply preferred by the owner, right? They don't want a disregarded LLC. They want a separate corporate entity. That's one big reason. The other one is the qualified small business stock exclusion. So LLCs that are taxed as C Corps are able to use this exclusion if they otherwise qualify for it. So that's one of the common misconceptions, is if you're looking for this QSBS exclusion on some of the gains if you eventually sell the company. It was often thought that you needed an actual just C Corp, and the regulations are pretty clear that the LLC can make a C Corp election and still qualify for that. Another reason for this is if you have a non-U.S. owner that owns that LLC. So if you're a non-U.S. owner, so again, let's say you're a citizen of the UK, you're not a U.S. person, and you own a U.S. LLC, depending on what kind of investments you might make in the U.S., it could create some adverse tax consequences for you if you leave it as a disregarded entity. So in order to rectify that, you file the C Corp election. You now have a C Corp entity, a U.S. corporate entity, and then so all the activities that are flowing through into that LLC are just taxed at the LLC level. And there's no pass-through to a non-U.S. owner, which can be beneficial in some circumstances. And then the last one is just simply some investment restrictions. So a lot of non-U.S. persons want to invest in U.S. companies or U.S. markets. And what they often find is there's some pushback. Let's say if you want to invest in a real estate fund in the U.S., and the real estate fund is a partnership, but they restrict investment to U.S. persons only. So if you're a non-U.S. person and you want to invest in this U.S. real estate fund, you need a U.S. entity, and it's got to be a U.S. regarded entity. And so for that reason, you can make this C Corp election, and then that will help solve that issue. Now you can go to the real estate fund and say, hey, I have a U.S. corporate entity. I'm not investing as a non-U.S. owner. I'm investing as a U.S. Taxable entity. Okay, so the S Corp election, very popular. A lot of S corporations these days. An S Corp election may be available to your U.S. LLC. So an S Corp election is available for disregarded single member LLC. So if you're a U.S. person, an individual, and you set up an LLC, you're the sole owner, you're likely going to be eligible to make an S Corp election, and that now changes it from disregarded status. So you had a single member disregarded LLC, And now you have a regarded LLC that's taxable as an S Corp. So once that election is filed and approved, the LLC is now taxable as an S Corp, and it can file a Form 1120S, which is the S Corporation income tax return. Now, what are some of the general requirements to be an S Corporation? Well, you first need a domestic eligible entity, which a U.S. LLC is. The owners of that LLC, generally, they have to be U.S. individuals, so a natural person. It can't be another U.S. company. And there's restrictions on the number of owners. So in order to have a valid S Corp, you have to have 100 or fewer shareholders. You can't have more than 100 or else the election is invalid. So for single member LLCs, only one owner, this is okay for you. You're generally going to qualify. Now, some of the S Corp characteristics, there's a lot of differences here, but the big ones are you still get the pass-through entity taxation. So you get a bit of both of like a partnership, disregard entity treatment, and some characteristics of what a corporation is. But you're still getting that pass-through entity tax status, which is generally preferable in most cases, rather than doing what we had before where you made a C Corp election where it's not pass-through, right? C Corps record all their income and expense, and they pay corporate income tax on their net income. And then to the extent there's any income left over as retained earnings, you could distribute dividends to the owners. Now, the ordinary earnings, this is one of the most appealing characteristics of an S Corp. The ordinary earnings that are passing through to the shareholders are subject to ordinary federal income tax, but they're not subject to self-employment tax. So this is one reason why a lot of individuals make the switch from disregarded entity to S Corp, because the disregarded entity, most of that income is going to be subject to self-employment tax. By making this election, the earnings are no longer to self-employment taxes, but you do have to do a bit more work, right? So you've got to set up payroll for the owners that are actively participating in the business. So that's beyond the scope of this video, but that's something to keep in mind if you go that S Corp status. Now, the foreign-owned DRE issues. So a foreign-owned disregarded entity is a U.S. LLC formed with one non-U.S. owner, but it's still a disregarded entity, just like if it was a U.S. person. Now, as I said earlier on that very first slide, when you have disregarded entities, generally they don't have to file their own separate tax return, and that's because all the income just flows through to the owner. Foreign-owned disregarded entities are a little different. You do have to file some type of return, and this is the Form 5472. I do have a lot of tutorials covering 5472 filings for foreign owners, and that return has to be filed with the IRS by April 15 of every year. And that return is required even in cases where the entity might not be subject to taxes. So it's more of an informational filing, but it's still required. And that's a new regulation that went into the place in, I would say, the last maybe 6 or 7 years. But it's really important to do, because if you don't do it, there's some pretty stiff penalties for failing to file this if you have a foreign-owned disregarded LLC. Now, if that LLC has one owner and it files an entity classification election for that C Corp status, well, now the reporting requirements change a little bit. You no longer have a foreign-owned DRE. You have a foreign-owned C Corporation. So the C Corporation files the 1120. There might be a 5472 included with the 1120 to disclose the foreign shareholder and any reportable transactions. But it no longer requires that 5472 with a pro forma 1120. Now you're doing an actual 1120, and then all the other reporting requirements that come along with it. So who is a foreign person for U.S. tax purposes? Well, certainly foreign individuals, so anybody that's not a U.S. tax resident. And U.S. tax residents include U.S. citizens, U.S. Permanent residents, so green card holders, or individuals that are in the United States physically enough days to meet that substantial presence test. So if you're somebody who is not falling within one of those three categories, you're considered a foreign individual, and you would meet this standard for a foreign-owned disregarded entity. The other items that come in there are certainly foreign corporations and foreign partnerships. So partnership, for example, if you had a limited partnership formed in the Cayman Islands, that's a non-U.S. limited partnership, so it's a foreign partnership. And if that LP owned a disregarded LLC in the U.S., then it would still need that Form 5472 with a pro forma 1120. Now, what kind of information is reported on that 5472? Well, if the LLC has any reportable transactions. Now, the reportable transactions, it's a bit confusing in this context because you're not really reporting income and expenses of the LLC. You're reporting movements of cash or property between the LLC and the foreign owner. So to the extent the foreign owner contributes cash to the LLC as a capital contribution, or they take out distributions, that kind of information is reported on the 5472. All right, and again, I have a lot of videos covering these topics in more detail, so I'll put links in the description below if you want to go check those out. All right, and then some more filings for foreign-owned DREs. Again, touched on this already, but the foreign-owned DRE needs to do that 5472 filing, even if it's not subject to taxes. Now, if you have a foreign-owned DRE that is subject to additional taxes in the U.S., then you've got some additional work to do. So what are two scenarios where you could have a foreign-owned disregarded LLC where you've got to do some additional filings? Well, the first one is any kind of effectively connected income. So if the company is engaged in a U.S. trade or business and has ECI, so effectively connected income, now, in addition to the 5472 with the pro forma 1120, the owner has to file an income tax return in the U.S. to report that effectively connected income and pays taxes. All right, so that's one scenario. The second one is if the owner, I've got it listed down here with the FDAP income, but I'll touch on it before we get into the examples. But if you have a U.S. LLC that, let's say, has a brokerage account and it has some dividend income coming through that wasn't properly subject to withholding taxes, now the owner has to file a return to report that FDAP income and pay the appropriate income tax on that U.S. source income. So let's look at some examples here. So for the ECI example, let's say we have a foreign corporation that has a DRE. So we have ABC Corp Limited. It's a foreign corporation that was set up in Bermuda, and the corporation owns 100% of a Delaware LLC. So that's its subsidiary entity, and that LLC has not filed a C Corp election. So it's just a disregarded entity, and it has a foreign owner, being this foreign corporation. The LLC owns and operates a restaurant in Orlando, Florida. And so given those U.S. activities, given the presence of the physical presence of the restaurant, the U.S.-based employees, customers, it determines that these activities in the U.S. create a U.S. trade or business, and we have some ECI. So the Delaware LLC has to file its 5472 with a pro forma 1120. And then in addition to that filing, ABC Corp has to file a foreign return, a Form 1120F, to report that ECI and then pay corporate income taxes on the net profits. And then, to the extent there's any distributions, they might be liable for the branch profits tax, or BPT for short. So what's an example with an individual? So let's say we have Sam Jones. He's a UK citizen living in London, so he's not a US person. And he does a similar thing, right? He opens a Delaware LLC as the 100% owner, and he does not file an election to be a C corporation. Same thing, the LLC is owning and operating a restaurant in Orlando, so the U.S. activities create a U.S. trade or business and effectively connected income. Delaware LLC has to file that 5472 with a pro forma 1120. And now Sam also has to file a 1040-NR to report the activity, the effectively connected income, and then pay income taxes on the net profits. Now, the last piece there, the U.S. FDAP income, so fixed, determinable, annual, or periodic income. This includes items like U.S. source dividends, U.S. source rents, royalties, other kinds of fixed payments like that. And so if you don't have the appropriate amount of withholding tax on those items, then you've got to file a return to report the income and pay the tax. So let's say we have Bob here. He is a Bermuda citizen, lives in Bermuda. He opens a Delaware LLC to open a U.S. brokerage account. Now, the brokerage account earned $1,000 of U.S. source dividend income, but because of, let's say, a mix-up in the paperwork, the broker forgot to withhold 30% in taxes before depositing the $1,000 into Bob's account. Well, Bob is still liable for the withholding tax, right? The withholding tax is 30% on the FDAP income unless it's reduced by a treaty. So because the tax wasn't paid, Bob has to file a 1040-NR to report the $1,000 in dividend income and then pay the 30% or the $300 in taxes to the IRS. All right. Okay, so now last but not least here, the difference between domestic and foreign LLCs. So this is really important. So within the regs, they outline the rules on disregarded entities and who qualifies, and there's different standards for domestic entities and then foreign entities. So domestic entities, which we've been talking about so far, so let's say a Delaware LLC, the rules say that it's going to be a partnership if it has two or more members, or disregarded if it only has a single owner. There's a different standard for foreign eligible entities. So the foreign entity is going to be a partnership if it has two or more members and at least one member does not have limited liability. So for example, a limited partnership. So a Bermuda LP or a Cayman LP, the limited partners are going to have limited liability, but the general partner will not. So those entities are going to be by default a partnership. It's going to be an association, which is another term for a corporation, if all of the members have limited liability. And then lastly, it's going to be a disregarded entity if it has just one owner and that owner does not have limited liability. So what is limited liability, and then how does this apply to foreign LLC? So a member has limited liability if the member is not going to have any personal liability for debts of the company. Makes sense. Now, what's important here is you have to be a little more diligent in reviewing the local laws of that jurisdiction and then the operating agreements of the LLC. So let's say you have a jurisdiction that allows an entity to specify liability exposure for the members. You've got to review those to see whether or not the member has limited liability. So for example, if you look at a Bermuda or a Belize LLC, the organizational documents and the statutes provide that, well, even if this has an LLC with only one owner, they're going to have limited liability. If that's the case, then it's taxable as a corporation. It's not a disregarded entity. And that's really important because I think people often confuse, well, if I see LLC behind the name, and if it's a foreign LLC, maybe it's just treated the same way as a U.S. LLC, and it's not. It requires a little more diligence. So in most cases, when you have foreign-owned, strike that. When you have foreign LLCs with a single member, they are often by default treated as corporations. So they're not disregarded entities. So if you're a U.S. person and you own 100% of a Belize LLC, you often have to treat that as a corporate entity. You're not treating that as a disregarded LLC. So if you're thinking about this in the context of filing your return, and you're doing your 1040 and you own 100% of a Belize LLC, instead of filing the appropriate documents to report it as a foreign-owned disregarded entity, you would be treating it as a CFC or a controlled foreign corporation. So you're having to do a 5471 instead of that 8858. Now, the foreign LLCs are likely still going to be an eligible entity, meaning that you can file an election to change it. So If you have a single member foreign LLC and it's treated as a corporate entity, not disregarded by default, if it's a corporate entity, you can still file an election via the 8832 to make it a disregarded entity for federal tax purposes. So if you're looking to set up a foreign LLC where you're going to own 100% of it and you want it to be disregarded, you can still get there. It's just not going to be automatic. So that's the big difference between the domestic and the foreign LLCs. Is the domestic LLC, it's by default disregarded. With foreign LLCs, by default, it might not be, right? By default, in most cases, it's going to be a corporate entity for federal tax purposes, even though it has that LLC behind the entity name. But you can file an election to make it disregarded if you want to do that. All right, so that covers it for this video. I hope that was helpful, just kind of summarizing the different tax attributes. Like I said earlier, I'll put some links in the description below for some other tutorials or more information on these, the varying, tax statuses, whether it's a C or S corp or a disregarded entity. And as always, I appreciate you watching, and I look forward to seeing you on the next video. Thank you.